Okay, friends, so we'll start with the new standard. And I want this particular standard, you have to be extremely attentive, understand how the flow works, because this is the very favorite standard of the ICA. Not many examination questions have come, but it has got a high potential that you could have been, so many questions can come from this particular standard. Yeah, because with this standard, we are already done with this third chapter also. Okay, we are spending good amount of time. Yeah, but I hope once that structure comes in your brain, like we can be much faster. Yes, so I want you to hear, listen very carefully and ask me if you have any doubts. Okay, so before we have a quick recap, overview. So we started with the chapter 3, started with the essay 300, then essay 600, essay 610 and essay 620. Now in essay 620, okay, well, just one point I wanted to talk about is about that uh, competency and capability, because if I take you back to that particular screen, okay, you can just go back again, because they have given you in the form of examples, para. So this, and in fact, everything is from the standards. Every language, every examples they have given, nothing is from out of pocket of the board of studies. Okay, we can make it a pointers like this. What are the factors a external auditor should consider related to competency capability of the objective of the auditor's expert? The point number one, he need to evaluate the expert has got necessary competency capability. You can say this is point number two, which they have told it is an example. Are they subject to technical performance standards? Point number three, see, rather than splitting and understanding other matters and all, you consider it as a 5 points. There are 5 pointers. One, you need to evaluate their competency capability. Are they subject to technical standards? Do they have relevant experience? For this, it is an example. But if you see, this is not an example. You see, this is not an example. This is actually a point. But this is an example because they are specifically talking about one circumstance. If they would have told one example, like there is an actuary or there is an engineer, he belongs to the Engineers Association of India, recognized by the government, then it would have been an example. Point number four, expert competence related to accounting and auditing requirements. And point number five, unexpected events happen. Like for example, you appointed an actuary for doing the, like say for example, you appointed one valuation officer in order to do the valuation of the building, and suddenly say there is a big crack happened or there is a big damage happened, earthquake happened. See, now you don't need that expert anymore, but in fact you need a damage assessment expert or a going concern assessment expert. Changes in the conditions can happen. Audit evidence obtained as a result of procedures, already we have seen. Actually worked on one report and it was a faulty report. See, you got an evidence that there is some problem with that actuary expert, so you need to reconsider. So the keyword here is reconsider. Unexpected events, changes in conditions, and audit evidence that makes to reconsider. So you remember these 5 points, enough. Competency, capability. And with regard to objectivity, how do you understand whether they have got necessary objectivity? For this, no, you need to have inquiry with the management, discussion with the expert. That is this part. You can ignore all this top point. You can say, how do you evaluate the objectivity? One, you need to have an inquiry. You need to have a discussion of what? Okay, interest and relationship. Which all those is all the four. Enough. Okay, so other than that, we understood. We have gone through yesterday in detail. Yes, so let us start with the essay 540. And if you see why this standard is very important, you pick any item in the balance sheet, friends, the probability is very high that the amount would have been estimated rather than you have to accurately measure. Agree with me? That's why this standard plays a very important role, because lot of a financial statement contains lot of estimates, including fair value estimates. Now, how an auditor has to consider those, like how we should audit those estimates, because the moment estimates comes into picture, chance comes into picture, because what they estimate may happen, may not happen. Followed? So in such cases, like there is a high risk that there is a risk of material misstatement. and somebody can take advantage of it. So how auditors should address that risk of material misstatement in estimates? He is supposed to follow certain set of procedures and he has to document them. Now, this standard deals with the auditor's responsibility related to estimates, including fair value estimates. Please understand, students, estimates and fair value estimates are not two different things. Estimate is the mother umbrella. Estimate have got two elements. One is called a fair value estimate, the normal estimate. I can say it like this. So I don't differentiate between this estimate and there is a fair value estimate. So no matter what is the difference between the both, we will discuss it as we proceed further. And whenever you have got estimates, you will have disclosures which is required by the AS, Ind AS. So auditor is concerned with the audit of those estimates and its disclosures in an audit of financial statement. It expands 315 and 330. That's why if you read this standard, it's very similar. It has combined both 315 and 330 requirements. So once you have understood what is 315 says and what 330 says, it's very easy. So what 315 says? SA 315 says you need to identify and assess the risk. How do you identify this? By risk assessment procedures. And once you have identified, how do you assess it? You will classify the risk into two buckets: overall risk, assertion level risk. Done. Finish. SA 315 is complete. What does SA 330 say? SA 330 says, look, whatever risk you have identified at SA 315 level, you need to design response. So what is that response for overall response? There is something called overall response. What is your risk at the assertion? You have got two types of response: test of control, substantive procedures. Now, under what circumstances you have to choose test of compliance, how you should do the test of compliance, under what circumstances you should do substantive procedure, how you should select the procedures, what you need to keep in mind. Done, finish, full stop. So now if you see SA 540, SA 540 also talks about the same thing. Here, risk you identified as an estimate or estimating uncertainty, because whenever you make an estimate, an uncertainty will come. That's what I told, chance. It may happen, it may not happen, because you are not able to measure it very accurately. So the ultimate outcome may be matching, may not be matching. So how to address that risk? How to design your audit procedure keeping that in mind? That's what we are going to see here. So that's why they said it expands on SA 315 and 330 and other relevant SA in relation to estimate. That means the way you perform standards audit, the same pattern you are going to see here also. It includes the requirement and guidance notes on misstatements of individual accounting estimates and possible management bias. You will understand what do you mean by bias? Possible management bias. So scope of SA includes accounting estimates and fair estimates and this related disclosures. I hope it's clear, students. Okay. First question, first concept we have to discuss here as part of introduction. See, we are talking about the introduction part here. We have not even gone to the standard. First, let us have some clarity about what is nature of accounting estimates. And I always told you, nature means what? What is accounting estimate? What is an accounting estimate? So let us get certain ideas about it. First of all, what they are. You see, students, recently, okay, it's also going on. Today is the last day. I attended Power BI training. Okay, I'm going through one training. I'm also sitting like you as a student there. 2 books completed. I'm noting down everything. In fact, what words they said, what jokes they said, every damn thing I'm noting, sitting and noting. I'm the only person. 2 books I finished. Everybody is watching me. I don't know, because this is how I do when I attend any training, any seminar. I don't know whether I'm not even read it. What I have written, I have not read till now. But see, that thing, writing, noting, scribbling, it makes your brain very attentive and it tries to fix things. I'm becoming very uncomfortable by looking at Power BI because I'm feeling it very difficult. But my confidence, my experience is, I spend more time with it. No, within next 3 or 4 sessions, okay, I start seeing the simplicity. And I hope, friends, you are also started to see the simplicity. Audit should feel simple. I hope it's feeling now. If audit doesn't look simple to you, it is very clear indication for me that you are not put that effort. Because for that matter, everything in this world is simple only. Tell me what is difficult in this world. Everything is simple. When things become simple, when that effort goes, when that focus, attention, your hands, mind, body, or coordination happens, no, then it looks simple. No, just to share, wanted to share my experience because I'm also learning something new now, like maybe what you're learning. So what is and what are the what they are? First of all, they are, if anybody asks you what are accounting estimates, you say they are financial statement items. Okay, but there are so many financial statement items. Are all financial statement items are estimates? No. They are those items which are not or cannot be measured precisely. Okay, so this is what you need to understand. That's it. Now, these are all the items which cannot be measured very precisely. That means you cannot take a tape or you cannot have a scaling machine and you cannot weigh and tell exactly this is the thing. It is not like a cash in hand, which you could have measured because it doesn't require, oh, I think I may have approximately so much cash. No, because cash you can count. Bank balance is not an estimate. You know exactly, you can measure FD, customer amount, receivable from the customer. But coming back to the valuation, there is a reserve for bad debts. That is a different story. But how much amount at what financial assets? Okay, they are not estimates, but they are subject to fair value estimates. Because debtor is a financial asset. It is subject to fair value estimate. But when you recognize for the first time, when you measure for the first time, there is no, you can measure it very precisely. So I hope you are clear, students. What are your estimates? They are financial statement items which cannot be measured precisely. Now, second question comes into picture. Like, why auditor is concerned? Why auditors are concerned? See, because auditors are concerned because in every estimation, there is some element called uncertainty. The uncertainty is something which can happen or cannot happen. This brings beauty because if everything was certain in life, then I don't know, or is life fun? No, somebody told the uncertainty, the risk itself has brought beauty to the life. Very beautiful quote. You see, if life was very certain, if everybody's life was very certain, then I don't know how this world would have been looked like. This world may not have been like this today, whatever. So now problem comes when your estimation doesn't have any uncertainty. That means it is very sure now that this is what is going to happen. Then we can say that there is no risk. But if it may happen or if it may not happen, then there is a problem. So now this chance could be taken by the management in order to manipulate the financial statements. Yeah, because you cannot measure precisely. It is a matter of estimation. So estimate something. Estimate the way you wish. So that you can play with the profit. Either you can increase the profit or you can decrease the profits. You can fool someone. And later you tell, oh, Baba, this is the information I had in my hand. This is what I thought. Okay, this is what I feel. Because when that future day comes, when you get the clarity on what it is, then there is a problem. Then all type of excuses are going to come. So I hope you are clear why auditor is concerned, because of the ROI. Now, why? What necessitates? What is the source of? Okay, I can say something like, we say that estimates are there, and estimates always have got uncertainty. Where this uncertainty is coming from? Why you cannot measure effectively? Why you cannot measure accurately? The root cause for this is business itself is uncertain. The business itself is uncertain. For this, why business is uncertain? For this, you need to understand strategic management. Strategic management says that there are so many components, there is so much complexities. It is not that you are the only one person doing business there. There are so many people, and each one is subject to different permutation and combination of things. The world is very complex. And because of this, no, there's so much uncertainty. It can be one government regulation could have been killed you next day. One powerful competitor would have wiped off. So many things can happen. So this uncertainty is going to translate into estimation uncertainty. Okay. So now, how that uncertainty can come? Okay. Further, this is one of the reasons. Second, the characteristics of an asset or measurement basis or your component can result into uncertainty. Okay, let us see this from the study material perspective. First of all, when this is my heading, they didn't give you. When they talk about nature of accounting estimates, first question comes, what are accounting estimates? You say it is a financial statement items, but which cannot be measured precisely. Now, for this purpose, we are going to call them as accounting estimates. Are you clear? Now, second question, why auditor is concerned? Because the information available to the management in making estimates varies widely. Because it is not that everybody will not have the same information in their hand. Because for every decisions, you need to have an information. Like, should I take this path or should I take that path? Like, you have come across these two paths. Maybe one tiger is waiting. Tiger is there. You don't have that information. Now, if you knew that there is one tiger, you would have definitely chosen this path. There is no uncertainty. But when you are standing here, not having information about both the path, see, your choices makes a lot of difference, friends, about your survival. Because by chance, if you would have moved here, then tiger would have killed you. Now, that's why that information is maybe limited. That's why there is always comes one uncertainty because of this lack of information. Now, the degree of estimation uncertainty, and this uncertainty is going to turn into risk of material misstatement. Like, you are not able to estimate whether there is a technological changes are going to happen or not. So imagine, students, you are the manufacturer of CD manufacturer like Moser. Technology has got changed and pen drive has come. Now you have got so much stock of CD. Followed. Now you are not able to figure out there is a change. See, this is an uncertainty. Because of which what happened? No, you make estimate of its value of the inventory, NRV. But in reality, that NRV may not be existing. Your NRV may be very low because of the technological change. Now, because what you should have done, see, this is your cash risk. Changes in the technology is going to bring cash risk. Now, what is the accounting implication? Its accounting implication, you should have made impairment of inventory. Impairment of inventory is accounting implication. And everything, and can you measure it very perfectly? No, it requires estimation. So management can play here. They may say that no, there is a still market for this, so and so. I hope it's clear. So the no information is available, no information, no provision for litigation is going to increase the reported profit. Somebody has filed a complaint against you, cash risk. So if you are supposed to make a provision, a loss account or a provision expenses account debit to litigation claims payable, but if you don't want to do it because you want to show more profit, that is your accounting implication. Not passing the journal entry for this risk sitting on your head is your inherent risk. So everything starts with the business risk, which is nothing but cash. Like somebody filing complaint against you can have cash implication. You don't make a provision entry. Accounting implication is your inherent risk. Okay, I can say like this. Business risk, its another phase is inherent risk. Business risk is nothing but cash risk. Inherent risk is nothing but an accounting risk. Okay. Next, what necessitates the estimates? Point number 1, uncertainties inherent in the business activities only create estimates. Like suppose business started to give, see, business has to give warranty. Like it's a mandatory by the government of India that anything you sell, that warranty has to be provided. So there are two types of warranties. So we are in India's 115 you study. Okay, you can have one service warranty and another is assurance warranty something. Like one is mandatory by default. It's called a manufacturer's warranty. Minimum say 1 month or 6 months or 1 year you have to give. Another is something called extended warranty. It is not required. See now whether should I give this? These are all my business activity parts. These are all my business decisions. Now, the very moment you start manufacturing and selling, you get into a requirement to make a warranty provisions because you have got an obligation on your head. This necessitates the estimates. Further, specific characteristics of assets give rise need to the estimate. Basis or method of measurement prescribed by the financial reporting framework also gives rise to the estimate. For example, what exactly they are trying to tell? This is point number 2. Like what necessitates estimates? One is your business activity itself. Like you take certain set of decision. Like for example, you make one announcement of retirement benefit. Till yesterday, there was no retirement benefit applicable to you. But today you have made an announcement to all the people that if you stay with us for 40 years, at the time of retirement, we will pay you one lump sum money. See, the moment you involved into some set of business activity, why did you do this announcement? Because you wanted to people work more, earn more. You wanted to earn more profits. But the moment you had this type of business practice activity, you have to make a provision for define the benefit obligation. Second, you forget about business activity. It's a very characteristics of the asset, liability, or equity only can result into your what is that called? Your estimates. Like for example, what are the characteristics of an asset? See, bad debt. The moment bad debt comes into picture, okay, you have got the RBD associated with it. So it's the very characteristics of the bad debt. Debtors is the bad debt. So the moment debtors comes into picture, it's the very characteristics is it can have a loss. So reserve for bad debts comes into picture. See, very characteristics of the asset has resulted. Like the asset comes into fixed assets comes into picture, warranty comes into picture. See, it's the very characteristics creates a need to make an estimate. It's not the business decision. Business didn't make any announcement. Okay, the moment the asset such one particular asset comes, it requires this. The characteristics of the liability, like the moment you have set up the plant, decommissioning liability comes into picture. Characteristics of the equity, like ESOP, you have given ESOP to the employees. ESOP requires estimations. In days 1 or 2, you must have done that. In Inter also, you must have done. You have to make an estimation of the fair value of the equity, distribute amount to the over the life, see whether it's an equity or there's a grant. Now, method of measurement, this is one thing. Characteristics of the engagement, point number A. And second, method of measurement prescribed by the framework. What is this method of measurement? Like for example, if you talk about Ind AS 109, it talks about the fair value to P&L, FVTPL measurement of the financial instrument or FVOCI. If it is an amortized cost, then there is no problem. But if it is an FVTPL, you have to measure the fair value. So this is what, because previously maybe financial assets were not measured at FVTPL, not fair valued under Ind AS. But now there is a need to do the fair valuation. So what is the fair value? It's an estimation. I hope it's clear. So what exactly they are trying to tell. So in the introduction part, we learned 3 things. What is a financial estimate? What is an accounting estimate? It is a financial statement item which cannot be measured precisely. Why auditor is concerned? Because of the uncertainty involved, there can be risk of misstatement. First of all, why that uncertainty comes? Uncertainty comes because of the 2 factors. One, because of the business activities, or because of its characteristics of the asset, or because of the measurement prescribed by the financial reporting framework. Because of all these reasons, an estimation comes into picture. Now, how accounting estimates are different from fair value estimates? As I told you, both are not different. I say accounting estimate sits at the top. Then there are 2 types of things called something going to get confirmed in the future and something is in the present. Okay, we can call it as a normal estimates, fair value estimates. We can, for our understanding sake, accounting estimates can be grouped into 2 estimates called the normal estimates and fair value estimates. Like what is the difference? Anyhow, we are going to see that in the future also. Now only I will tell you so that we can quickly proceed with the study material. See, there are estimates are something like guessing about the future. Why? Because there is an uncertainty right now. Now, what are the normal estimates? I can say something like this. Today or now, there is an obligation. but you don't know exactly. When you will come to know? You will come to know only in the future. Actuals you will come to know only in the future. For example, students, I can ask you, did I ask you to write mock test 1, chapter number 1? Yes. Did I ask you one question? How much do you expect? Did I ask you this question? Yeah, why? Because I want you to be very good in developing expectations. Huh? Because generally, always after writing exam, we always feel, okay, this time I have written well. Okay, but later, no, the institute might have been, actual could have been different. Then we feel bad because expectation minus reality is that always I told you that equation. So what we need to do, no, always we need to have a fair estimate. I mean, our estimate should be very accurate because that brings us more towards the reality. So if I can guess correctly what's going to happen in upcoming days, I will be more towards the reality. Now, when you expected, when say 2 days back, now what is reality that you are going to come in 2 days from now? Follow? So this is like, I can call it as a normal estimate. This is more like a normal estimate. In normal estimate, you have done some activities today. Its implications you don't know right now. That implications of that activity you will come to know only in the future. But the timeline is crossing now. You cannot wait for that day. Somebody is asking, tell me your estimate now. Please freeze now. Because when you are trying to upload in the Google form your mark sheet, the return sheet, you must have seen that fields are mandatory. You cannot skip it. So now you have given some estimate. Let us try to compare how much expect and what is reality. But I hope this part is clear. What is your estimate? Okay. Now coming to fair value estimate. See, fair value estimate, I can say you don't have any obligation as such. Now only you have, there is no future. No future. Now only you have to figure out the value right now. Okay, like for example, I wanted to sell my mobile. Okay, there is no obligation on me. I may sell or may not sell, I'll keep it. But what is the price I can get for this right now? Please understand, students, in the obligation, you have got some obligations which will be confirmed only in the future. But in this thing, no, you have got a requirement to measure something right now. That is called your fair value estimate. Okay, can we have some examples? Anyhow, we are going to come across those examples in the future also. With the example, I can explain you so that you will be much more clear. Other examples we will see later because I gave some generic analogical example. One, tax provision, warranty provision. If you see tax, you incurred some income, you have sold something, some obligation, reserve for bad debts, you got a debtor, but its implications you will come to know only in the future. But 31st March, you have to finalize the balance sheet. So what you do, you make one estimate of the tax, you make one estimate of the provision, you make one estimate of the reserve for bad debts. I can call this as a normal estimate or you can call it as an accounting estimate. You have got a financial asset. And as per the Ind AS, these financial assets, okay, say for example, you have got a debtor. Financial assets, you have to be valued at a fair value through P&L account or FVOCI, whatever, FVTPL. Let us take an example. That means you have to figure out the fair value, like you have got investment in the shares of Reliance company. Now, as on the balance sheet date, what is the value of the Reliance company shares? They are not concerned that in 1 year from now, how much is going to happen. Right now, what's the value of the shares? Because I have to measure my financial assets or investments in the Reliance industry at the market price on 31st March. This is called fair value estimates. So fair value estimates are at this point of time. Accounting estimates are also at this point of time, but the implications are in the future. So this part is very clear to you. Yeah, because they will ask you some examples of accounting estimates and fair value estimates. Now, we spoke about the estimation uncertainty. Okay. In fact, we have to discuss this later again. Estimation uncertainty. They have shifted up and down in the study material. Now, estimation uncertainty means, what is estimation uncertainty? That means there is an uncertainty. First of all, you cannot measure something accurately, no accuracy. But that accuracy may widely differ from reality. If this uncertainty is very high, because you cannot, first of all, you are estimating, but that estimation also, if you cannot do it, and there's a possibility of wide uncertainty, this is, we can call it as an estimation uncertainty. Now, does this estimation uncertainty occur every time, everywhere? No. Some of the accounting estimates have got low accounting estimation uncertainty. And since they have got low estimation uncertainty, ROMM is low because your estimation accuracy will be very high. Some of the accounting estimates may have high estimation uncertainty. So in the study material, what they have given, see, they have given what are those factors. Please understand here, please mark it very important. What are the factors which results into low estimation uncertainty? Why for some estimates the estimation uncertainty is low? But if you see the second part, it actually looks like an opposite. It's actually opposite of the first part. But they are talking about the examples. Please understand, not factors. That's why they come into litigation, input model, wage, negotiations, trade union. See, both, understand, no? In the first case, it's not an example. Huh? The second part is an example. So in the examination, when they give you something, don't just write the opposite of this, because it's actually an opposite. But be careful, are they asking you examples or are they asking factors? Because both are different. Then what happens? No, you write something, you start estimating, oh, I have written. But in reality, what you was written might have been totally different from what was expected. It's not that you don't remember. This becomes an application problem. Why? Because there is no clarity. And the moment you realize, oh, this is the factors and this is an example and this is a high risk area, then you have actually addressed that risk. So your objective should be to identify the risk and to have a strategy for that. And you say, sir, audit is simple. Why people are telling it is difficult? Okay. So now let us understand what are those factors. Why for some estimates the estimation uncertainty is low. Just give me a minute. Yes. Okay. So why estimation uncertainty is low for some of the estimate? I can write here why low estimation uncertainty. Okay, I can call the one of the important reason is business is not complex. Okay, business is very simple. Okay, you have got, like, for example, you are doing only one idli. You are a local idli manufacturer. You have got one shop. Only idli you sell. Nothing. You don't sell anything else. Now you tell me, friends, will that person, the idli, that hotel owner, will be able to estimate how much idli should I prepare next day? More accurately or less accurately? You will be able to predict more accurately. Why? Because only idli is selling. Business is very simple. But the moment you get into a business where you are diversified, you have got different types of items available. Now, the moment you give choice to the people, now the same person can be trying different items on different days. You cannot. The estimation uncertainty comes into picture. The day you think that idli I should be doing so much idli will remain because people didn't eat idli that day. Everybody shifted to upma and upma was short. So what I can say, the complexity of the business, if it is low, okay, the business is not complex. This is one of the factors. Then I can say that If you are frequently making it, then you will have a low estimation uncertainty. If you are doing once in a while, then your estimation uncertainty will be very low. That's why students, I'm going to ask you, chapter wise you tell me, what is the estimation you are going to earn, your estimated marks. What happens, students, once you start frequently making estimates, then when the final examination comes, your estimation will be more accurate, because you start develop that gut comes from inside. Instead, you're estimating only once in when you are writing the examination. Then the estimation uncertainty will be very high, because you're not skilled to make that estimate. So I can say that something like frequency is going to affect. The third thing I can say, from which ready data. If the data is readily available to you, then I can say estimation uncertainty is low. Do you agree with me? Like whenever I give you this, I can give you one suggested answer also and say make an estimate. Your estimation accuracy will be very high. You will be in a position. But when ICA will release the suggested answer, they will release only after the results have come. Before examination, they can release immediately the day they release the question paper. After the exams are done, suggested answer also can be released, because suggested answers are prepared by that time. You see, you should wish they could have given, but they want to keep yourself in your own estimate world, not to reality. Because if they really wanted somebody to approach reality, then the moment you see the data in your hand, you understand your estimates are going to be changed. But you don't know only how an answer key will be available. I hope you are getting. And fourth, I can say the method and the framework is very simple, like objective. You see, after any examination, you ask any student, they can pinpoint and say like out of 30, this many MCQs are correct. Because the method is very easy there, but descriptive is very difficult. Descriptive, it's very easy, it's very bit difficult. Okay, and you have got some models. Like your models are going to add, like that, okay, if you are going to use some models and all, that means you have got one very good framework. Like if I give this parameter, this is mark I'm going to get, yes, your estimation uncertainty will be low. So these are all the factors. Because of these factors, estimation uncertainty is low or some of the estimates. Ulta, they can ask you why estimation uncertainty is high for some of the accounting estimate. Then what you should write in the examination, remove this not. Okay. Then they asked you, give me some examples where uncertainty is very high. Okay, then I can say outcome of litigation, because litigations you cannot say in court what can happen, it all goes with the argument. So estimation uncertainty is very high. Second, if you have got a derivative instruments not publicly traded, if it's publicly traded, you open the newspaper, you got the price, you go to the website, you got the price. But if it's not publicly traded, how do you derive its price? So its estimation only has to be done, and its estimation uncertainty is very high. Now you have got a highly specialized entity model and no observable input. You don't have any observable input, and entity only designed one model. You only know what you did. It's very complex for outsiders, because they don't understand what went inside, how this evaluation happens. Okay, I can say something like this. Institute has got a mechanism to correct your answer paper. Agree with me? They have got an evaluators, they have got called answer keys, where stepwise marking is given. Now, do you aware how this inside works? Not works. Can you see what type of inputs goes there? You can see. They give you suggested answer, but ICA has always told you, they have been claiming, they have been telling from the time immemorial, that suggested answer and answer keys are prepared by two different people. Suggested answer is prepared by the board of studies to help the students. Answer keys are prepared by the examination department, and both are independent. Board of studies gives you study material. That's why from the study material they say this will be the suggested answer for your exam. In examination, how many alternative answers are given and all, and how many answers, how the instructors have been given instructions, should they refer verbs and all, This is highly common. That's why your estimation uncertainty is very high now. This is the reason why, because highly specific entity specific concept. Inputs you don't know only what is going there inside. And the fourth one, like a wage revision agreement where negotiations are going with the trade unions. I hope students you are clear. Let's go to the study material and understand it. You see now, I'll tell you from the your audit point of view exams, because whatever examples I was giving, it's more analogical. Idli, sambar and all. Now you see here. Now, first question can come in the examination. Why for some accounting estimates, accounting estimation uncertainty is low? Alternatively, they can ask you same thing, why estimation uncertainty is high? Don't write these answers because they didn't ask you examples. Please don't write these answers. You're not going to fetch any more. What is that you need to do is a very simple thing. Accounting estimates arising in entity in the business activities that are not complex will give to low estimation uncertainty. Remove not, it will give you high estimation uncertainty. So you are supposed to write the reason. I can say reason rather than factors. What is the reason that there is a low estimation uncertainty? Because of its complexity of the business activity. If the complexity is low, your estimation uncertainty is low. Like in second PUC, can't you estimate? Can you estimate how much marks you will score in accounts? You can easily score because complexity is low. In CA final, complexity is high. So single product versus conglomerate. I told you already. Somebody's organization is having a single product. Estimation is very simple. Conglomerate organization estimation is difficult. Now, if you are frequently making estimates and update because they related to routine transactions like provision for rent, you didn't pay the rent, but tell me, can't you estimate how much is the rent? You can measure it very easily, like provision for electricity charges, provision for your petty expenses. But if I have to talk about the litigation and claims once in a while, so estimation becomes difficult. So if you are frequently making, it is low. If you are not frequently making, it is high. So I hope students how to answer this question in the exam. If the accounting estimates are coming from a data which is readily available, like published data, exchange traded prices, etc., we can call it as an observable. In such cases, estimation is low. If it is not from a readily observable data, estimation uncertainty is high. Like if I ask you, what is the fair value of Reliance Industries? If you have made investments, right? You say, sir, very easy. Open the newspaper or go to NSE website, you know. But if I ask you, what is the fair value of ABC Private Limited shares? Now dividend discount model, okay, cash flow model, okay, your P pricing, so many things are going to come into picture. Now, fair value estimates where method of measurement prescribed by the applicable financial reporting framework is very simple. It is low estimates. Like for example, fair value estimates. If I talk about the bond, you tell me if you have invested in the debentures, what does your Ind AS 109 says? It says very simple. It's a financial liability because you know exactly how much amount and when to pay. That clarity is there with you. So how to find out the fair value of it? They suggested you discounted cash flow method. They said what? You find out the present value of all the future cash outflows. That's the fair interest rate. That is the value. See, there's no uncertainty. But finding out the fair value of the equity shares, because method is not simple. Okay, it can be any method you could have chosen. That's why it can be difficult. So your estimation, whether it is simple, what your index says, it also depends. And fair value estimates where model used to measure the accounting estimate is well known or generally accepted. Like for example, once upon a time, there was absolutely no clarity how to value the derivative transactions. Okay, like options, futures, forwards. There was no clarity only in this world. Then, particularly options, there was no clarity, like how to value an option. I can say like, what should be the call premium I should be paying? See, then one model came for which they got a Nobel Award. They are called a Black and Scholes model, which is there in your AFM. You are learning that. Okay, standard normal distribution and one complex equation. But that model brought fantastic clarity into the valuations, like what should be the price, what should be the fair value. Followed? Now, if your fair value estimates you are making and you are using a model which is generally accepted, then your estimation uncertainty is low. Imagine if you are using some Monte Carlo simulation and all, which people generally are not using, their estimation uncertainty is very high. So I hope students, these are all the factors are very clear to you, and they can ask you in the examination what is the reason estimation uncertainty is low or it is high. Then definitely they will ask you question. Give me examples where estimation uncertainty is high. They will not tell you, give me examples where estimation uncertainty is low. No, they will not tell you. I'm damn sure about this, because they are not given in the study material. What are those? Outcome of litigation. Yes, estimation uncertainty is high. What is the reason? Because they are not frequently made. Second, fair value estimate, derivative financial instrument not publicly traded. Why? What is the reason? Derivative which is not publicly traded. One, either because there is no model available, or because there is no observable data. Reason. Now, fair value estimates, highly specialized entity developed a model. That means it is not generally accepted. Entity only developed, and inputs also you cannot observe. And accounting estimates in case of wage revision agreements. Okay, you are doing one wage revision bonus and all, where still negotiation is going on, or government has to permit, and your sanction is awaited. Okay, in that case, uncertainty comes. These are all the examples. Just friends, see, we spent considerable time. Okay, I could have just skipped it, but I feel this is a much risky area. That's why I'm spending more time here. Yes, in fact, these two examples they should have discussed after this para, degree of estimation uncertainty. Anyhow, no problem. They should have discussed it after, but we have discussed before. Anyhow, we will go through. Now, the degree of estimation uncertainty varies. Like for what is an estimate? An item of the financial statement. Now, is there any uncertainty associated with this estimate? Answer is yes. Why? Because of the business practice, because of its characteristics, or because of your financial reporting framework methods. Fine. Now, is that estimation uncertainty same for everyone? No. Please understand here, we are talking different concept only now. I hope you are clear. You are clear what is estimate? It's a financial statement item. Why we are calling estimate? Because we cannot measure accurately. What is the reason? Because there is an uncertainty. From where that uncertainty came? Because of these three reasons. Now, what is degree? That means this estimation uncertainty is not same for everyone. Why it will vary? I can say there are three reasons. One, the nature of the accounting estimates. Like what is being estimated? Like you have to estimate the electricity consumption. It's very easy. Degree of estimation is low. Uncertainty is low. But if you want to predict next year's sales, then estimation uncertainty is very high. So first question comes, what exactly you are measuring? Like depreciation. Uncertainty is low. You know fairly, okay, this building may last for 25 years. Or my income companies act is telling this is the rate you should be using. Reserve for bad debts. Hey, Baba, it is very difficult. Companies that didn't tell me what is the percentage I should be using. So it is my experience. The extent to which it is generally accepted method used to make the estimate. Okay, so if we are having a generally accepted method, okay, depending upon that, estimation uncertainty will be different. Like you have got a discounted cash flow method, Black and Scholes model. Accordingly, your estimation uncertainty will be different. The subjectivity of the assumptions used to make the estimate. Understand here, subjectivity of the assumption. And after this para, they should have asked you question. Tell me some estimates. What is the reason why somebody it is low, why somebody it is high? Give me some examples. Okay. Anyhow, once you have gone through, you will understand it. So there are three reasons for degree of estimation uncertainty variation: because of its nature, because of the availability of generally accepted method, and subjectivity of the assumption. So two elements we need to understand. What is subjectivity? Subjectivity means personal bias, judgments rather than variable fact. Like subjective versus objective. Objective, there is no bias. No personal bias of the evaluator will be involved. Out of 4 questions, you have ticked one. So there is absolutely no judgment involved here, because the answer is yes or answer is no. Finish. Either you will get marks or you will not get marks based on your choice. But if you have written one para, now there's a lot of subjectivity comes into picture, personal bias will come into picture. Second element is called assumption. What is an assumption? Assumptions are the expectations of the future. Since estimates you are doing for the future, okay, do you make certain set of assumptions? There are some uncertain factors. You will assume, like that's what economics you start. Assuming everything is equal. You go to Black and Scholes model. You say all these are constant, which is impossible. But without making certain assumptions, you cannot propose the theory only. How they can propose the Black and Scholes theory? How he can say demand and supply theory? Adam Smith, and how they can propose it? No, they will say, assuming everything else is equal, this is one of the factors. No, you want to evaluate multiple things, then there is a multiple factor element comes into picture. So there are different methods. So what is subjectivity of the assumption? See, first of all, assumptions are inherent. Assumptions are expectations you are having. Okay, like you wrote one mock test. You are assuming that I will do liberal correction. Now, is that assumption subjective? Followed, no? The moment subjectivity of the assumptions comes into picture, that means the assumptions what you are making is based on the judgment rather than verifiable facts. So if you cannot have any verifiable facts in your hand and you expect something, that is called a subjective assumption. I hope it's very clear to you. Okay, like attrition rate 6% for defined benefit plan. Attrition rate means how many people will leave out of the organization, because the moment somebody leave out of the organization, you can stop making provision because you are not paying them something what you have promised to pay 40 years from now. So is this 6%? Can I verify it? Because this is the assumption you are making, that every year 6% of the people will leave and 6% of the people will come. Every year 5% of the people will die and 5% of others will continue. So all these are the assumptions what you make if you want to make a provision for retirement benefits. Now can I verify that 6%? If answer is yes, then your assumptions are not subjective, but your assumptions are objective. But if I cannot measure it, then it becomes subjective, and automatically this gives one advantage to the management to involve in fraudulent financial reporting, because they can play with their assumptions. Okay, so this is very important. Please mark it. Degree of estimation uncertainty. Why it varies? Because of the three factors. Now, not all financial statement items involve estimation uncertainty. We have already seen what is the reason. Because they are frequently made, their observable data is there, model is generally acceptable. These are all the reasons because of which non-financial statement involves estimation uncertainty. For some of the items where active or open market data provides readily available data. Sometimes estimation uncertainty may exist even when the valuation method is defined. See, please don't make one generic assumption that okay, the moment market data is available, you can have an estimation. There is no estimation uncertainty. For example, you may have a market valuation. Like for example, you wanted to buy 5% of the Reliance Industry shares. Now you say, what is the fair value of Reliance Industry? Very simple, sir. Go to the newspaper and see yesterday's what is the closing price. Say, Papa, please see here. I am buying 5% stake. I am not buying 100 shares there. Okay, what is the fair value of 5% stake now? Somebody is willing to sell me 5% stake. Now, by having a 5% stake, probably I may get a representation in the board of directors. By 100 shares, I will not get that representation. So, I may have to pay some sort of premium. Now, there can be some illiquidity. I may have certain restrictions that this 5% stake I should not be selling because I become an insider. Now, tell me what is the fair value? You told no. If market valuation is available, if the valuation method is known, we can easily find out. So that does not mean, please understand, even though open market data is available, you may have to make certain set of adjustments, and this creates an estimation uncertainty now. So estimation uncertainty exists. Securities quoted at an active and open market, like where the holding is significant or there is a restriction on marketability, then fair value estimation uncertainty comes. In addition, general economic circumstances prevailing also creates like illiquidity in the market. Because of the war, there is a lot of illiquidity. That also creates a fair value. Like for example, any examples we can take. Now, examples of situations where you make accounting estimates other than fair value estimates. This is that first example I asked you. I was talking no here. This one. You see how they are organizing the material. Now they are talking about something called, tell me some examples of accounting estimates which are not fair value estimates. They have not given any name to this, because I always told you both are not different. Accounting estimate sits at the top. It has got two elements called fair value estimates, non-fair value estimates. I can say like this, non-fair value estimates, like allowance for doubtful debts, RBD, inventory obsolescence, warranty provisions, depreciation, provision for investments, okay, where impairment, outcome of long-term contract, financial obligation. If you see all these examples of accounting estimates who are not fair value estimates, see, something happened right now, its impact you will come to know only in future. I hope it's clear. Now let us see what are the examples of fair value estimates. You see, students, complex financial instruments not traded in open market, but why you need to do your financial reporting framework? India said value at FVTPL. So now you need a fair value right now, not in the future. From 1 year from now, what is its value? What is reality? You are not concerned. Right now, what is the value of this financial instrument? Share-based payments, ESOP. Now you have promised to pay something. Okay, what is the fair value of that equity right now? Property and equipment held for disposal, you are supposed to do it a fair value. Certain assets and liabilities acquired for business combination, because goodwill, business combination says fair value should happen. Transactions involving exchange of assets and liabilities between independent parties without monetary consideration, like barter type of thing. Non-monetary exchange of plant and facilities in the different lines of business. Like, you need to know the fair value. Who told you? Ind AS 115. You have to find out the fair value of those consideration, because you need to figure out the transaction price. I hope it's clear, friends. These are all the examples of fair value estimates. Yes. Second, the first point here, when we talk about estimation uncertainty, we spoke why estimation uncertainty varies. And the second thing, we are talking here that not all items are subject to estimation uncertainty, and estimation involves your judgment. Okay, so it involves making assumptions which is very inherent and that are uncertainty at that time. So auditor is not responsible for predicting the future conditions and transactions, because even if known that at the time of audit might have significantly affected the management actions and assessment, because you don't know what is the implication of. So nobody can predict the future. Auditor is not responsible for predicting the future events. So always one judgment will be involved of the management, because that's the reason we call it accounting estimates, because we cannot measure objectively, accurately with a verifiable fact. Yes, sure. So we will make one small note before we proceed further, because what we have learned now, we need to have a clarity like how it is organized. Okay, let us have one, make a mind map. Then we will proceed further. Yeah, we can just take 1 minute break for water break. But you saw, no? So how beautiful, how tricky they have designed, like the standard is, and very few examination questions are there. So these are all high probable examination questions. Rest now we will see. From chapter number 4, we can be much faster. But the first 3 chapters are very important for you. And 6 you forget, because only MCQs they are going to ask you. We'll finish within maybe 2 days. But first 3 chapters you thoroughly study. Then our next stop will be chapter number 7. Yeah, we'll just take 1 minute break. Yes, sir. So we'll start writing about this particular thing. So write the heading concept 5. Say 540 estimates. But you have to study entire standard name, auditing accounting estimates, including fair value accounting estimates and related disclosures. For our notes, we will write only this much. What is scope? Accounting estimates plus related disclosures. Auditor should check. Auditor's responsibility is related to accounting estimates and related disclosure. Okay. First of all, nature of estimates. What they are. Financial statement items which cannot be measured accurately. Why auditor concerned? Auditor is concerned with the estimation uncertainty. This is the only reason, because if you can estimate accurately, I don't have a problem. The only problem is estimation uncertainty, because of which ROMM is going to come into picture. Why estimates, or what necessitates estimates? Why they come into picture? There can be three reasons. Uncertainty in business activity. You cannot predict the implications of business activity. Second, characteristic of FS item. Its very nature only creates an, like cash. There is no estimation uncertainty, or there is no estimation required. Bank balance, no estimation balance required. Debtors, because of its character, estimation is required. And measurement basis by FRS, financial reporting framework. Like, what does your financial reporting framework says? Then primarily I can talk about here under the nature of estimate, what they are, why they come into picture. Give me some examples. Okay, so when you talk about examples of AE, accounting estimate, we can primarily group them under two categories: non-fair value, fair value. Yeah, which is discussed at the later part. I feel I should have been discussing at the part of nature only. When I talk about estimates only, I should tell you so many things about estimates. Now you'll be much clear, like how the concepts are flowing. What is nature of the estimate? It's like this. This is what. This is the reason. Okay, give me examples. So examples can be like this. RBD, reserve for bad debts. No, you write in your language in exam properly. Account of relevance for doubtful accounts. inventory impairment or obsolescence, warranty provision, depreciation, tax provision, which is not there, but we can always say litigations, provision for litigation cost. These are all the examples of your non-fair value provisions or accounting estimates other than fair value estimates. Examples of fair value estimates: 1. Valuation of financial instrument not actively traded financial instruments. Actually, whether it's actively, non-actively, not required. Financial instruments, I can say. Share-based payments, ESOPs. I can say business combinations. Assets should be valued at a fair value. Exchange of assets. Property held for disposal. Yes, that's it. So we have given certain examples. Okay, so when we talk about the nature, first thing we spoke what they are. Second, why estimates are required. Third, why auditor is concerned with that. And we give some examples also. I hope by now you will be much clear. And there is one more element, the fifth thing you need to tell about estimation uncertainty. Yeah, with this, no, I hope our discussion will be complete with related to the accounting estimates. Okay, there is one more thing called management bias. Okay, anyhow, we can connect that later. Now, one question comes: what is the estimation uncertainty? Why degree of estimation uncertainty vary? Why vary? Why estimation uncertainty vary from item to item? Because of its nature of estimate, like what you are estimating. Generally accepted method of doing estimation. If it's available, your estimation uncertainty will be low. And subjectivity of assumptions, because assumptions you have to make. There are not even a single estimate till now which you can make without assumptions. Assumptions are very inherent to the your estimates. Like for example, what is this assumption? You have gone to so many marriage functions, so many functions you have attended. Did you assume, well, before going, that there is a food? Did you ever pick the phone and called your friends or relatives, okay, there is a food, no, we are coming, we are not cooking anything at home? Yeah. Now, this is why, because it's generally accepted. This is how the general practices are. And what happened now, every time when you made a guess, that there will be a food, and there was a food. So now subjectivity is gone. Now it's measurable now, because your assumptions are working. I hope it's clear. So estimation uncertainty can vary because of the three factors. And second element you need to understand, not all FS items involve estimation uncertainty. Okay, now one question comes, because you said not items involve estimation uncertainty. One question comes, why low for some of the items? Okay, now we can write an answer, because business is not complex. Second, they are frequently made. Third, input data is observable. Model which does the process is generally accepted. See, this is like process, I can say process. That means input. Input is observable. You know what exactly has gone on, and you know how the input is getting processed. Their estimation uncertainty is low. And method by FRF, because FRF itself contribute to it, is simple. Whatever FRF has suggested a method, that is simple. These are all the reasons why estimation uncertainty is low. Then examples of high uncertainty. One, you will generally have litigations, high uncertainty. Second, derivative contracts, not publicly traded. You have high uncertainty. Examples. Third, either entity specific models or input not observable. Okay, this point they have given without telling which example. Example they should have given. Wage revisions. Okay, and there is a second point called estimation involves judgments. Okay, we can just ignore it. So this is how the first part is organized. I hope you are very clear. Yeah, two more elements we will try to understand. Okay, one is called management bias. Two more points we need to understand. Okay, so we wrote about something on what is an estimate, why auditor is concerned, what necessitates estimates, examples of estimates, then estimation uncertainty, why it is going to vary, and why it is low for some estimates, high for some other, because not all items have got the same estimation uncertainty. So this was point number 5, right? This is 5. So two more points we may have to write here. Point number 6, management Now, what is management bias? I'll give you, I think I had told you this example, that thief and the goat. One person will be there, three thieves, he is carrying the goat. I told you this example. Now, bias means your judgment is influenced. You cannot be able to think clearly. Now, when this person told that this is a dog, did he believe him? He didn't believe, because his decision is, he was firm that he is carrying a goat. But when the other person told, another pattern happened. Our mind starts to observe patterns. Please understand. Please understand yourself first. Don't get biased. Now the mind started to observe the pattern, and he also started to believe that this must be some ghost. So bias is something which is very difficult to identify in isolation. Like when you speak with me for the first time, you will not come to know, neither I will come to know about you. But when I speak to you again, or you speak to me again, and in our conversations which subsequently happen, we may be able to figure out our attitude, our beliefs. Correct? Agree with me? Now that belief could have been a biased belief, and we may not be aware. Maybe I am inherently negative, or I am inherently positive. I don't know. Please understand. Or I may be aware that I am negative. There can be two situations. I could have been aware, or I may not have been aware. When you speak for the first time, no, you may not be able to figure out my attribute. But when you repeatedly speak, no, in my all conversations, you see one element coming common. Instantly, you recognize that there is some bias. Maybe I'm a negative person, I'm a positive person, I may be extrovert, I may be an introvert, influencer, hacking your mind, God knows, whatever. You'll be able to see. So that is the concept of a bias. Now, financial reporting frameworks often call for neutrality, because in the Indians we have learned, when somebody is preparing financial statement, they have to be freedom from bias, and they have to be very neutral. They should not think from their personal point of view. Now, what problem comes? Since estimates are imprecise, because of its very estimation uncertainty, they can be influenced by the management. Followed? Such judgments may be unintentional or intentional. Okay, because you may wanted to achieve some desired results. So, like for example, I ask you to correct yourself, or I say make one correction. Say you may be very lenient in giving correction, because you justify yourself. Okay, Baba, they may give me marks. And see, because since if I tell you, you have written say one test, 30 marks is objective, 70 marks is subjective. If I tell you, please evaluate yourself. See, in objective, there is no bias. There is a neutrality, because either it is correct or not correct. When it comes to descriptive, no, you can get into some bias. You may award more marks to yourself, or you may be very conservative and award less marks to yourself. And you may not be aware what you are doing. So, will I be able to identify? No. If I look your only one paper, I will not be able to figure out that bias. But if I consistently see the way you respond to the test papers, I may be able to figure out the bias. So when the estimation depends more on the personal judgment, it becomes easier for the management to influence the result, whether intentionally or unintentionally. The chance of bias is more if subjectivity is involved. This is what they are trying to explain here. The susceptibility of an accounting estimate to management bias increases if the subjectivity is involved in making it. It is a very small sentence, but you see the meaning, no? What it means. They say that the chance of this bias is more. Here, you don't have any chance of bias, but the chance of bias is more the moment I bring subjectivity in the estimates. Agree with me? So, unintentional management bias are inherent. Subjective decisions, they are often required in the estimates. So, for continuing audits, indicators of possible management bias identified during the audit during the preceding periods influencing the planned risk assessment. That means if I find that you are much biased, then I have to be extremely careful, because I should not allow that bias to come in. Now, management bias is difficult to detect at an account level. That means one single item, I will not be able to figure out the bias. But when I consider the aggregate group of items in my one story, no, it's very difficult to make bias because when one person speaks. But when I aggregate them together, then I'll be able to figure out. Or I have to aggregate all the accounting estimates. Or I should observe this estimate over a number of periods. In such cases, now I'll be able to figure out a bias. Okay, slight underestimation they are making in provisions. Very small amount of underestimation they are doing. And okay, so I will be able to figure out because it's a very small estimation. But if you see continuously, if you are doing, like for example, you see students, again, I can give one more example. Now, you travel in a bus. Bus conductor doesn't have a ticket or doesn't have a change. So on a ticket, he will write, say, 2 rupees due to you. Now tell me, is he biased? You may say, no, sir. Okay, because with one instance, we will not be able to figure out what is going on in their mind. But the moment you figure out, you sit and observe, this conductor is doing for everyone that small 1 rupee, 2 rupee. He has in his pocket, I can see that money is there. But 1 rupee, 2 rupees is doing, and he knows that people will forget. Out of 10 people, 2 people may say, sir, where is my 1 rupee? So at the end of the day, he might have figured out one way to manipulate something. So this is what they say, that it's very difficult to define that bias at the item level, but when you aggregate together multiple things or over a period, you see this conductor is doing every day same thing. You will be able to figure out. Did you see, students? Any damn, so many areas our audit applies. I don't know, audit, what you're reading is not audit, what you're reading is risk. The moment you inherent it, you get into your blood, you will be able to see everywhere. Although some of the management bias is very inherent, there may be no intention to mislead. Okay, sometimes it can be very genuine. Okay, there is no intention, because his intention may be, sir, if I start giving this, then at the end of the day I may not have any change only, so I will have a problem. In an emergency case, I am retaining that money. Okay, maybe that's they may be. But if you see that the intention is there to mislead, then this becomes very fraudulent in nature. If management is intentionally doing that underestimation or intentionally increasing that estimations in every RBD, inventory, depreciation, everywhere, then the action seems to be fraudulent. Okay, the last element for the day. What is the measurement objective of the estimates? So you have got two measurement objectives. Like, why do you measure? First of all, why you have that calculations done? It depends upon the applicable reporting framework. The objective for some estimates is to forecast the outcome of one or more transactions. Okay, like transaction happened now, you estimate that effects in the future. You are going to forecast, like tax provision, income you earn now, provision you will make for, because assessment is going to happen next year. You sold the item now, warranty claim is going to come only in the next year. So your measurement objective is to estimate the forecast of an outcome. And for other estimates, including fair value estimate, the measurement objective is different and is expressed in terms of value of current transaction now only. It has nothing to do with the future, like estimated market price. So it's in simple, they are talking about here fair value estimate. Here they are talking about other than fair value estimates. Like we already give the difference of examples: tax provision, here financial instruments, valuation. Okay. Applicable reporting may require the fair value measurement in an arm's length price. Why do we call it as arm's length price, students? Arm's length price means it is a fair price. See, if this party, I can give you why we call it as an arm's length price. Please understand. If you and your friend, will you be close or will you be different? Yeah, you will be holding hands, you will be putting hands on the other person's shoulder, and some goose piece you will do. Nobody will listen, nobody will be able to hear what exactly you are speaking, because you are very close. Do you permit a very stranger to be very close to you? You see, no? To where you keep a stranger, your friend, a very close friend. That friend is touching you. His hands are on your shoulder, comes very near to your ears and tells something. Because you permit that. But with a stranger, no, you don't permit a stranger to come to near to your ears and tell something. Okay, put on hands on. You don't permit. So you always keep an arm's length gap with the stranger. Now, because of this, what happens? Since there's the arm's length gap is there, you can find one arm's length gap between two people. Now, they can't do gusu gusu pisu pisu and all. Now, whatever they have to speak it loudly so that other party should hear. And when they're speaking, people who are witnessing, they will also be able to hear it. That's why this becomes, that's why we call them arm's length is a fair value, because people know exactly what is getting discussed there. It's not that they don't know, they are not even in a position to hear. And this happens only with the related parties. So you have to estimate the market participants equivalent in the arm's length price. Now the difference between the outcome of an accounting estimate and amount originally recognized, this is your estimate and this is your actual, does not necessarily represent misstatement in the financial item. This is the particularly case of fair value estimates, as they are observed invariably affected by the event subsequent. That means, okay Baba, you estimated something, but what actually became something different, that does not mean that is a misstatement. Okay, it can be a prepaid item, it can be an error also. Okay, it need not be a material misstatement also, because what information you got at that time, it was very limited to you. Okay, so now we will end up writing a note, and from now we are coming to SA 5. What is management bias? We will learn about management bias. Okay, what you are going to tell here? Point number 1, FS, financial statement, or FR. FRF require neutrality. Financial reporting framework requires neutrality. Estimates are influenced by management judgments. Now, these judgments or judgments or subjectivity increases scope for management bias. Bias means they are not neutral. See, first of all, FRF want them to be neutral. Now, estimates involve judgments, and judgments give scope for bias. Okay. Now, how to detect? Difficult to detect at account level. That means if you take single account, it's very difficult to detect. Then what you do? Aggregate of group of estimates. You verify aggregate of group of estimates or all estimates. You see, you can make a group of estimates, like all litigations only you verify, then you will understand. Or all the estimates, whatever management they have done, you verify. Or observe over number of period. Or one estimate you take and see how many, every year how they are doing that estimate. So these things can help you to determine. And the last thing, bias can be intentional or unintentional. And fifth point, you need to say sixth point, if intentional, they are fraudulent. They'll be considered as a fraudulent. If any of the bias seems to be intentional, so if anybody asks you, what is management bias? Anything asked in the examination on management bias, write this story. FRS requires neutrality, estimates influenced by the judgment. These judgments will result into management bias. It is very difficult to detect at account level. It should be detected only by this method. It can be intentional or unintentional, and if it's intentional, it's fraudulent. Whether the word management bias you come across, no, just write this story. How much mark I awarded, that estimation uncertainty is there, but the chances are there 1 or 2 marks too you can get for this. Now tell me, is it very difficult to write this point? The word management bias means this thing should come. Estimation means nature. Nature means so many things should come to your brain. Okay, and objective of measurement of the estimates, we will skip it. Okay, so we will go on the further, because I don't think so they can ask you any examination question like what is the objective of estimation, either to forecast the outcome or value a current transaction. So you can just make a note of it. Yes, friends. So thank you. So we'll continue in the evening.